It's become hugely important. Obviously, as a firm, we've been doing deals in Indonesia now for many, many years. We've had an office in Singapore for over 30. So we've been working on regional deals for many, many years. And Indonesia historically has been our busiest market. Obviously, in the last 3 or 4 years, things have improved drastically in Indonesia in terms of its the economy and the fundamentals. And as a result, we're seeing a huge amount more interest from our private equity clients, our hedge fund clients, corporates, and even many of the banks financing some of these deals. Valuations are tough. Obviously, post the global financial crisis, there's been huge valuation differences between sellers and buyers in terms of their expectations. And that's led to a huge number of aborted transactions that we've worked on over the course of the last few years. It hasn't been helped by the fact that the IDX has increased over 200% in the last 2 or 3 years. And as a result, buyers and sellers' expectations on value are constantly shifting, which doesn't help in terms of getting deals done. And we've acted for many clients over the course of the last few years on sell-side mandates that haven't successfully closed, where they've flip-flopped between a trade sale back to an IPO and back to a trade sale. So hugely frustrating, and hopefully things are going to change in the run-up to the 2014 presidential election in Indonesia, when I suspect that people will start to reassess valuations going forwards. I think the obvious country to mention here would be Japan. Many of our Japanese clients, the corporates and the trading houses, are very active in this particular region. Malaysia, Singapore, Indonesia, the 3 main countries, and Indonesia specifically for resources and consumer goods. So we've seen Suntory tie up with GarudaFood quite recently, and many of our trading house clients are looking at deals in the region, in the resources sector, petrochemicals, etc. And that's a function of the Japanese yen being so strong, low borrowing costs, slow domestic growth in Japan, and the need to find accelerated growth in other parts of the world, and Indonesia is clearly on the map for that. I guess you're referring to the fact that CVC and TPG have been successful, and in the case of CVC, that's obviously had a lot to do with the Riyadi family. The 2 deals that they've done there involved the Lippo Group, and in the case of TPG, obviously they've got their tie-up now with North Star, which has been a great success as far as anyone can see. And it's obviously helped them to source new deals. Some of the other clients that I've been working for, some of the global private equity clients, haven't had as much success because they don't have necessarily those connections to the main controlling families in Indonesia, and they don't have the on-the-ground presence. Yeah, I mean, as I said earlier, there have been a number of aborted transactions over the last 24 months or so, which has been a huge source of frustration to me and to my clients. But I think due diligence is key on any transaction. But importantly, in a country like Indonesia, it's important that you do your due diligence and you do it well. Obviously, there are changing regulations all the time. Clients are very concerned, particularly in the likes of the coal mining industry, where regulations are generally pretty new anyway, but there are suggestions that some of those regulations may change. The other key issue is making sure that you've got experienced people working on the transactions, whether it be the local people that you're looking to tie up with your JV partners, or your advisors, whether it be legal or accounting or financial advisors. The law isn't black and white in Indonesia. It's very rare that you can get a legal opinion on anything relating to Indonesian regulations. And it's important, therefore, that advisors can tell you, okay, this is a risk, but in practice, we don't see it as a substantial risk.